Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola, and Malaysian palm oil.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, Paris Rapeseed. We've had two patterns here, two completed patterns that had been the main influence on this market since as far back as the summer. First pattern is an overextension of the bright red neckline, which is currently at 454 even, of the May to August 2025 head and shoulders pattern. This is a less common head and shoulders continuation pattern type. The bright red neckline also shows up in the second pattern. In this case, it acts as a lower trend line together with the nearby bright green upper trend line, currently at 459 even, that together formed a shallow July to October descending wedge pattern. We had a break higher over this pattern 6 weeks ago, a good break higher, and as I said back then, and I quote, I feel obliged to lay out, if not targets yet, then potentials. Thus, a primary potential will be up to the 489 3/4 area, with a secondary, harder to reach potential up in the 502 even area. Of course, if this becomes a false break on the upside, then I'll retire these potentials in a heartbeat. End of quote. 5 weeks ago, I solidified those potentials into targets, with target X, the primary at 489 3/4, target X1, the secondary up at 502 even. Since late October, we have seen prices move up and away from descending wedge pattern, but also get caught between the mauve medium moving average, currently at 475 even, and the gold long moving average, currently 478.5, plus the dark blue neckline extension to the August to September 2024 reverse head and shoulders pattern, which is currently 483 1/4 and has been capping the market. I said 4 weeks ago, and I quote, pushing above the gold long moving average and especially the dark blue neckline extension will be key to any attempt higher. However, if prices stabilize below the mauve medium moving average, then the pressure will be to try and push back down to the bright green upper trend line. End of quote. These comments still stand today, as prices have tried pushing up through the dark blue neckline extension, but this week, and not for the first time in recent weeks, the market has pushed down heavily, enough that yesterday we pierced the support last week we saw, seen by the green short medium moving average, currently 473.5, and today prices have punched down below it. I'm now on the verge of retiring those topside targets as prices approach the 50% Fibonacci line for the May 23 to January 25 move at 467.25, which is a possible support area, and the bright pink February 24 today uptrend, which is currently at 466.25. Now, anyone who has been following any of my Rapeseed commentaries will know that bright pink uptrend is not really any support at all. I'm afraid we will have to start looking at whether the market will start testing down to the bright green upper trend line again. Now, on that basis, I would start looking at the late October to late November action as a possible double top, with potentials, not targets yet, of a primary potential down in the 470 zone, which the market has already achieved, and a secondary, harder to reach potential down in the 464.5 zone. The key pattern here had been the fairly obvious bright red late June to late October bear channel. 9 weeks ago, prices spiked down to the May 23 low at 611.10 within this bright red bear channel, but then bounced up from there. Initially not by far, as it seemed the pattern came to the market rather than the market moving to the pattern. But it did lead prices testing and finally breaking upwards 5 weeks ago over the bright red upper bear channel line, as well as pushing up over the 2021 low at 629.5, plus the lesser Fibonacci line at 632.90, and then last week challenging and stabilizing over the bright green short medium moving average, currently at 640.10, before 2 weeks ago making a small gapping move higher. Actually, it wasn't last week challenging, it was 3 weeks ago, but never mind. Before making 2 weeks ago, making a small gapping move higher over the significant combination of the June 21 low at 655.90 and the 50% Fibonacci line for 2025 at 655.70. And prices continued higher, but then, unsurprisingly, ran into trouble around the slowly declining mauve medium moving average, currently at 655.20, and the extraordinarily flatlining long moving average, currently 662.90. Further above is what may be the significant dark blue April to August head and shoulders neckline, which is currently at 681.20. Thus, we ended up and out of the bear channel, and we almost, though not quite, seemed to start to form a small October to date bull channel. However, this bullishness faded under the capping pressure of the mauve medium and gold long moving averages, plus the 50% Fibonacci line for 2025. And this week, prices turned lower for small November and early December base double top, and we crashed down through it all yesterday, extending the fall even further, down through the green short medium moving average, which is currently 640.20. In the process, the primary target for the small double top at 641.40 was reached today, just leaving the secondary harder to reach target X down at 630 even, just above the 2021 low at 629.60. There's one final thing I would like to tidy up. I said 5 weeks ago, I said about the move higher at the time, that, and I quote, "This just now leaves us with potentials topside for the breakout of the bear channel." Now the following are potentials, not targets, as it's still too early for targets, but a primary potential will be up in the 680 and 3/4 area, with a secondary harder to reach potential up in the 720.5 area, and a tertiary, much harder to reach potential up in the 751.90 area. As I said, these are at the moment not targets for the pattern, just potentials, end of quote. Then I decided to follow 3 weeks ago to solidify them into targets with a primary target X1, 680 and 3/4, and secondary hard to reach target X2 in the 720.5 area, and a tertiary, much harder to reach target X3 up in the 751.90 area. Given what's happened since, I cannot still validate these targets, and I'll be retiring them after this commentary. Bursa Malaysia crude palm oil. To start with, as I've done for many months now, I'd look to the wide congestion area that's overhead between 44.08 to 45.59. We tried in mid-October to pierce it and failed, with prices punching down through the lower edge of this congestion, as well as most of the moving averages, which are still underneath them. Prices also dropped down through a wide congestion zone made up from the 38.2% Fibonacci line of the May 20 to March 22 move, and the 50% Fibonacci line of the May 23 to December 24 move, both at the same 42.74 level, along with the 38.2% Fibonacci line of the July 19 to March 22 move at 42.39, and finally the July 23 high at 41.89. These have all now become resistances, as the new recent overall pattern here is the dark blue mid-August to early October bearish Andrews Fitchhawk. And we can see in the action in recent weeks in between the dark blue lower time below, which is currently 39.18, and a dark blue middle time above, which is currently at 41.13. This pitchfork has in recent weeks been exceptional at showing the slowly declining support and resistances. This week we have tested the overhead dark blue middle time. Now, stepping back a bit to view the overall picture, I said 2 weeks ago we can look at the whole August to date action as a possible double or even a triple top. If that is the case, then as I said 3 weeks ago, so that's now 5 weeks ago, as I said 3 weeks ago, and I quote, we have potential still available down to a primary target X in the 41.18 zone and a secondary hard to reach target X1 down in the 39.40 zone, end of quote. The primary potential and target was achieved, but it still leaves the secondary hard to achieve potential and target X1, still available at 39.40. I also added 2 weeks ago, and I quote, additionally, the whole mid-October to date action could also be seen as a possible descending scallop pattern, which is like a reversed letter J. We have had the drop, then the rounding base over the last 2 weeks, and then today could be the last day in a 3-day bearish evening star pattern, though that's not as yet determined. But if it is, then we'll see a test of the base of the recent action in the 40-50 area. We'll even have potentials and even targets below. But I'm not yet comfortable with this pattern idea to lay out targets or even potentials below. But I would like to be aware of it, just in case, especially after October's monthly key reversal down. End of quote. This is still all the case, and I'm watching carefully for further possibilities below. And there's also potential there for a diamond pattern, which I will leave open as an idea at the moment, but just open. In the way, and this showed up last week, we have, as I said 2 weeks ago, and I quote, we do have a band of congestion below around the dark blue lower tine between February 2011 high at 39.53 and the lesser Fibonacci line at 40.26. However, to be honest, this is not that powerful a congestion, but it seems enough for now, hence the stalling ahead of target X1, end of quote. Now, this is still the case, so watch out for congestion at 39.53 up to 40.26. There is one other further feature which I would like to discuss, something I've already mentioned since June. This all came about because I was at the end of June speaking about it in a presentation at the Biofuels International Conference and Expo in Brussels, Belgium. I've also recently spoken about it in November at the 28th World Ethanol and Biofuels Conference in Brussels. It was and is to watch out for a key level from now until the end of this year. So not that far away now. That level is 35.99. I always preface this by saying, and I quote, I know it's quite a long way below the market, but still nevertheless it is important. End of quote. Well, we are a lot closer to that level, highlighted on my daily chart in a black line box, than we were in mid-October, and that is why it is important. You see, if prices push down below 35.99 before the end of this year, which even now seems far away, then we would have set up the conditions here in palm oil to make that rarest of patterns, an annual key reversal, with all the implications such a huge long-term pattern may bring. Please watch out for this, as it is important, and I will bring you more detail should we get down below there, even though I know, as we are today, still a few hundred ringgits above it. Just please bear it in mind, so we still have some time left before the end of this year.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.